Your money feels like property because the interface was designed to make it feel that way. You open an app, see a balance, tap a card, send a wire, and the system responds instantly. But economically, that number is not a pile of cash waiting for you in a vault. In a bank deposit structure, your balance is a liability of the bank and an asset of yours. That distinction matters because a liability depends on the condition of the institution that issued it. When people say, "My money is in the bank," what they often mean is, "The bank owes me money." Those are not the same sentence. That is the first structural truth. The system does not primarily operate by storing your purchasing power in a static container. It operates by transforming your deposit into part of a larger credit and maturity machine. The public narrative is safekeeping. The economic reality is intermediation. Your deposit becomes funding for a balance sheet that must stay liquid enough to meet withdrawals, solvent enough to absorb losses, and politically important enough to receive support when stress becomes systemic. This is why money inside the banking system is conditional in a way most people never think about. Access depends on the health of the institution, the architecture of insurance, the behavior of policymakers, and the macro environment surrounding rates and liquidity. The system does not need to seize your balance outright to weaken your position. It only needs to expose that balance to inflation, maturity mismatch, policy discretion, and counterparty dependence. That is how ownership becomes softer than it looks. To understand why your money is not fully yours in practice, you have to look at incentives instead of slogans. A commercial bank benefits when deposits are stable, low-cost funding. You benefit when your balance is liquid and redeemable on demand. Those goals coexist only as long as confidence holds. The bank wants to earn spread by extending loans or holding securities. You want immediate access with minimal risk. The institution earns by putting duration and credit risk to work. The depositor assumes the system will always convert that structure back into immediate purchasing power. That tension becomes clearer when you look at policy architecture. Standard deposit insurance coverage is capped, $250,000 per depositor, per insured bank, per ownership category. That is not universal protection. It is a capped guarantee inside a defined legal framework. When Barack Obama signed Dodd-Frank on July 21, 2010, Section 335 permanently increased the basic insurance limit to $250,000. Structurally, that did two things at once. It improved confidence after the 2008 crisis, and it reaffirmed that deposits require a state-backed confidence layer because private balance sheets alone are not enough to guarantee universal trust under stress. A second mechanism sits deeper in the plumbing. On March 15, 2020, the Federal Reserve announced that reserve requirement ratios on transaction accounts would be reduced to 0%, effective March 26, 2020. That did not mean banks suddenly became reckless by decree. It meant the old public intuition that deposits are rigidly anchored by a visible reserve formula became even less relevant. Modern banking is managed through capital rules, liquidity facilities, collateral, market funding, and central bank backstops, not through the simple image of your money sitting still somewhere waiting for you. A plausible implication is that most people still imagine a warehouse model of banking, while the system operates more like a dynamic liability network. The 2023 banking stress made this visible in public. On March 12, 2023, Janet Yellen, Jerome Powell, and Martin Gruenberg issued a joint statement saying that depositors at Silicon Valley Bank would have access to all of their money, including uninsured deposits. The same day, the Federal Reserve established the Bank Term Funding Program, allowing eligible institutions to borrow against certain securities valued at par. Powell later stated on March 22, 2023, that the program was created so banks holding safe and liquid assets could borrow reserves against those assets at par. Structurally, this means your access to your money can depend not only on your bank, but on emergency policy actions that extend liquidity when mark-to-market reality threatens confidence. Who benefits from this architecture? In the short run, depositors benefit from continuity. Banks benefit from reduced run risk. The broader system benefits from avoiding forced liquidation spirals. Who absorbs the cost? Ultimately, the cost is socialized through lower market discipline, altered incentive structures, special assessments, inflationary tolerance, or future regulatory burden. Yellen noted in May 2023 that the proposed special assessment to replenish the Deposit Insurance Fund after the March bank failures would fall mainly on larger banks. That is a reminder that stability is never free. The financial consequence is simple. What appears to be private money often rests on public backstop, institutional discretion, and redistributed cost. This pattern is not new. In August 1971, Richard Nixon ended dollar convertibility into gold, effectively closing the Bretton Woods gold window. That decision did not erase money overnight. It changed the constraint around money. Once redemption into gold was suspended, the dollar became more dependent on policy credibility, sovereign power, and confidence in state-managed fiat architecture. Structurally, the public still held dollars, but the nature of what those dollars represented had changed. Go back further and the same principle appears in another form. In 1933, Franklin Roosevelt's gold actions suspended convertibility and restricted the domestic role of gold in the monetary order. On April 20, 1933, Roosevelt formally suspended the gold standard and prohibited exports of gold, as well as conversion of currency and deposits into gold. That matters because it shows that legal claims to money are always nested inside a political framework. The definition of money, the conditions of redemption, and the boundary between private claim and public necessity can all be changed when the system judges stability more important than prior assumptions. The historical pattern is consistent. When monetary stress rises, systems tend to migrate away from hard constraints and toward administrative flexibility. In 1933, the constraint was gold convertibility. In 1971, it was the external gold anchor of Bretton Woods. In 2008 and after, the constraint became confidence in private banking balance sheets without state support. In 2023, the stress point was uninsured deposits meeting unrealized losses and duration mismatch. The parallel to today is direct. Money inside the system increasingly depends less on static backing and more on policy-managed liquidity, confidence engineering, and institutional intervention. So what does this mean in measurable terms? First, purchasing power and access are not identical. You may retain nominal access to bank deposits while losing real purchasing power through monetary expansion, negative real rates, or asset repricing. The system can preserve the unit count in your account while reducing what that unit can command in the real economy. This is why the difference between nominal safety and real safety matters. A stable bank statement does not guarantee stable economic power. Second, liquidity support changes asset pricing. When banks can access central bank funding against securities at par rather than selling those securities into a stressed market, the immediate pressure of forced liquidation is reduced. That stabilizes institutions in the short term, but it also changes the transmission of risk. Losses that would otherwise surface through repricing can be delayed, transferred, or absorbed through official facilities. This suggests that modern markets increasingly price not just private fundamentals, but the probability and terms of public intervention. Third, deposit structure itself redistributes risk. Insured deposits and uninsured deposits do not behave the same way under stress. Yellen's 2024 remarks explicitly referenced vulnerabilities revealed in 2023, including increased shares of uninsured and concentrated deposits and unrealized losses on loan and securities portfolios. That combination matters because concentrated uninsured funding is more flight-prone, while unrealized losses reduce flexibility if institutions must sell assets to meet withdrawals. The observable pattern is that confidence-sensitive funding can vanish faster than asset books can adjust. That is classic liquidity mismatch. Fourth, the more the system relies on confidence backstops, the more rational actors must separate convenience from sovereignty. Bank deposits are efficient for transactions. They are useful for short-term liquidity. They are deeply integrated with payroll, payments, and daily commerce. But they are not the same thing as final, politically neutral monetary settlement. That distinction is why some capital migrates toward hard assets, some toward short-duration instruments, and some toward monetary networks designed to reduce counterparty dependence. Bitcoin enters this conversation not as rebellion theater, but as an alternative settlement asset whose core promise is not yield, but ownership without bank liability. The positioning implication is not that you abandon banks emotionally. It is that you stop confusing utility with sovereignty. A rational actor treats bank deposits as one layer in a broader structure, useful for payments, exposed to inflation, dependent on policy, and bounded by institutional rules. Once you see that clearly, you stop asking whether the interface feels safe and start asking what legal, monetary, and liquidity assumptions stand behind the number on the screen. When people say the money in my account is mine, they are expressing a social assumption, not a full structural analysis. In ordinary conditions, that assumption works well enough, but the system underneath it is doing far more than custody. It is transforming deposits into funding, relying on confidence, using public guarantees selectively, and calling on central bank liquidity when the maturity structure begins to crack. That does not mean the system is fake, it means the system is conditional. And once you understand that, the conversation changes. You stop treating finance as a morality play of heroes and villains. You start seeing incentive gradients. Nixon changed the convertibility regime in 1971 and expanded fiat discretion. Obama signed Dodd-Frank in 2010 and locked in a larger federal insurance backstop. Yellen, Powell, and Greenberg intervened in 2023 to protect depositors and contain contagion. Different eras, different people, same structural lesson. The definition, safety, and accessibility of money are shaped by institutional design and policy response, not merely by your personal sense of ownership. That should not make you panicked, it should make you precise. Responsibility begins with seeing things as they are. Stewardship begins with refusing comforting but incomplete language. If your money depends on bank solvency, deposit insurance limits, liquidity facilities, and monetary policy, then your task is not emotional reaction. Your task is structural awareness. The person who understands the machine does not need to shout at it, he positions around it. This is 21 protocol. Freedom is not a feeling, it's a structure. If you don't build your